Hey guys, in this video, I want to talk about how you apply a tax treaty to passive income. So a lot of times with expats, we're looking at you're going to have wages, earnings from your business, things like that. And we're trying to figure out how is the foreign country going to tax it? How do we make sure we get a credit or exclusion in the US? That's one piece of the puzzle. The other piece, though, that comes up a lot is how is your passive income taxed? If you move to Spain, you become a tax resident in Spain, but you have a U.S. brokerage account. That brokerage account is going to be spitting off capital gains, dividend, and potentially interest. Spain's going to tax that income, but so is the U.S. So this is where we have to figure out who gets the primary tax right. And it's not always that simple, and it's not consistent country to country. So I'm going to specifically be talking about Spain in this case, and we're going to look at the Spanish treaty just because I had a client that this situation just came up on. And we'll talk about how this concept applies more broadly. So general rules for taxing passive income as an expat, how the treaty applies, how to actually look through the treaties. And I'm going to show you exactly how I would walk through it if you were my client. Let's assume in this case, we have a U.S. person, and they are here in the U.S. over here, but they've moved over here to Spain. So they're a Spanish guy, and they're going to be receiving income from the U.S. So they have this brokerage. Let's just call it bank here, and it's going to be paying interest and dividends. So Spain's going to tax this income, but the U.S. is still going to tax it. So that's when we have to look at the treaty. The treaty is not getting you out of taxes generally, at least as a U.S. citizen. What it's doing is it's assigning the primary tax jurisdiction and telling you who gets a credit. So let's look at the treaty. I pulled this off the IRS website. The first thing you do when you look at a treaty, all U.S. tax treaties, they have what's called a saving clause. So if you look at Article 1, it has some general stuff here, but the important part here is in Article 1, Paragraph 3. Notwithstanding any provision of the convention except Paragraph 4, a contracting state may tax its residents and by reason of citizenship may tax its citizens as if the convention had not come into effect. So you go through this whole thing just for the IRS to kick it back and say, you know what? We're going to tax you regardless of what the treaty says. That's basically what this is saying. And then there's these exceptions to the saving clause. That's how this whole thing works. But let's think about it. Let's start with interest, because I think interest is a good example. I'm a U.S. person here, happy, living in Spain, receiving interest income. Let's say the interest income equals $100. So Spain's going to tax this income. Let's say the Spanish tax is 30%. So we have $30 of Spanish income, and then we're going to have U.S. tax as well. So obviously that's a bad result. So what we want to do is figure out what the treaty tells us we can do about that. Interest is Article 11. So interest says, interest arising in a contracting state and derived by a resident of the other contracting state. So let's think about what that means. Derived by a resident of the other contracting state. So in this case, it's arising from the U.S., but derived by a resident of Spain. May be taxed in that other state. So it may be taxed in Spain. However, such interest may also be taxed in the contracting state in which it arises. So in the U.S. But if the beneficial owner of the interest is a resident of the other contracting state, so Spain, the tax shall not exceed 10% of the gross amount thereof. So what this is saying is the person living in Spain that receives U.S. interest, the U.S. can keep 10% of it. And that would usually come from withholding tax. This is where it gets tricky with citizens. We have to go back to the saving clause and say, you know what, and I'm not going to go back up there because there's no exception to that, but the saving clause says the U.S. can tax their citizens regardless of what this says. So the U.S. gets full taxation rights if you just look at these two things. And the other thing is you have to actually define this residency term. So we'd have to actually make sure under Article 4 that they're actually a resident of Spain in the first place, because if they weren't, Spain wouldn't be able to tax this income at all, and so we're back to U.S. income only. But in this case, we're saying resident of Spain, U.S. source income, U.S. citizen. So now all that's happened in this scenario so far is Article 11 says Spain can tax it. And then it says the U.S. can only have 10%, but they're a citizen still under Article 1, so the U.S. gets full taxation too. So we're back where we started, where both countries can tax the whole thing. So now it's a question of who gets the credit. So the U.S.'s regular tax code is going to say it's U.S. source income. Spain doesn't care because the treaty is saying Spain can get the income. So that's when we have to go to the relief from double taxation article, which is Article 24. So I'm not going to read through this whole thing. I'm going to jump to the last part, which is what's important in this case. And what it says is, in the case of an individual who is a citizen of the U.S. and a resident of Spain, income which may be taxed in the U.S. by reason of citizenship in accordance with paragraph 3, that's the saving clause we talked about, shall be deemed to arise from Spain to the extent necessary to avoid double taxation. So that says, okay, the U.S. can tax it, but you can call it Spanish sourced so that you can get a full credit in the U.S. That's great. But then we get to this last sentence and it says, provided that in no event will the tax paid to the U.S. be less than the tax that would be paid if the individual were not a citizen. So we just read in Article 11 that if they weren't a citizen, the U.S. can keep 10%. So there'd be 10% withholding on this. So the U.S. gets $10. So in that case, we have to pretend they're a non-resident, and this is saying the U.S. can get the first $10. If Spain taxes more than that, then the U.S. can get a credit. But in this case, it's just the $10. So in that case, Spain has to give a credit for the $10 because that's what Article 24 is saying. So in Spain, they're going to give a credit for the 10. So you have 20 in Spain, 10 in the U.S., and this gets you back to the total 30%. So that's what this treaty is all about. It's splitting the tax between the two. And it can be a little tricky when it's not just a blanket, Spain gets the tax or U.S. gets the tax. And you see that a lot, not as much with interest income, honestly. A lot of times with interest, it is just this concept deemed to arise in Spain that's called resourcing. Usually you have a blanket resourcing rule for interest. Dividends are trickier because dividends, a lot of times it is the U.S. gets the first X% and then the other country gets the other percent. So in this case, Spain taxes it, but has to give $10 back in this scenario. So the way you practically would work through this is both countries have to draft their tax returns, right? So we have to draft a U.S. return and they draft a Spanish return. And so we have to see in the U.S., what is the tax in Spain? And they have to see from us what was the tax in the U.S. so that they can get a credit, and then we match them up to make sure at the end of the day, the total tax is not more than $30 between the two, and the right country is getting the right amount of tax. This whole game of international tax compliance and planning, it's a coordination event between the two countries. So you have to be talking to each other. It's good if your accountant knows somebody in the other country. If not, that they can at least work together. As far as this goes, that's how you would work through this scenario. Where a lot of people get stuck is they go straight to the interest article and it says, okay, it's going to be taxable all in Spain or all in the U.S. And they forget you have to come back and use the saving clause, say the U.S. is getting the full amount. The practical side of this, though, is that what if we get to a scenario where you explain this to the Spanish accountant and they're like, no, I don't agree with that. And that is actually the situation I'm in right now with a Spanish person where they're saying, we can do that, but they're going to get audited in Spain. It's going to be a nightmare. And we don't believe that they're going to actually win the case in Spain, which is a little hard to believe because the case is very clear based on the treaty that you laid it out to them. But I'm not going to argue that because I don't know the administrative procedures in Spain. I don't know how it works. If you get audited, how difficult that process is. So then it comes down to just doing what is most practical. So if we want to avoid an audit in Spain, what they're saying is they need to pick up the whole tax in Spain. That creates a risk in the U.S. because in that scenario, we would be picking up none of the tax in the U.S. because their tax is not going to be 30% in the U.S. So we'd get a full credit in the U.S. and they wouldn't pay any tax in the U.S. on the interest. So at the end of the day, the choices are in that scenario, pay double tax which is a bad answer, or take the credit in the US and basically hope you're not audited in the US or you're going to be in the same scenario. A lot of times I'm taking that option in the US, even though it kind of depends on the amount, right? Like if it's $100, then I'm not going to fight the Spanish authorities over $100. We'll take the credit in the US. And if they get audited in the US and we have to pay that $100 back or $10 back in that case, it's not a big deal. But if it's higher than that, a lot of times we need to find a second opinion in the foreign country to get it right, pay double tax potentially. In my experience, working with the right people in the foreign country, it's the same thing in the US, right? Like if you have an accountant in the US that doesn't have experience with international things, they're going to dig their heels in the sand on a position in some cases just because they're not comfortable doing it the right way because they don't understand the process. And it's not that it's the right way. Like in this case, they're just doing it the conservative way. He knows if they pay all the tax in Spain, then they're not going to have any problems in Spain. But he's worried if he takes a credit, he's just not comfortable with that position, even though it's the right one. But that's just because he doesn't do it. The moral of the story is you got to have people that are in the foreign country and in the US that have experience doing these things so that they can work together and get to the right answer. And we're not just guessing and hoping you're not getting audited in one place or the other. But anyway, as far as the tax treaty goes, I think it's always helpful to walk through it and see like how you actually get to the answer and use the tax treaty. And I'll do some more videos on this, kind of walking through different types of income, but that's how you do it for Spain with interest. It's very similar in other countries walking through. You walk through the same articles, they might say something slightly different. But if you have questions on this, if I can help you apply the treaty to your case, let me know. We're happy to walk through the exact scenario to make sure at the end of the day, certainly you're not paying double tax, but you're not also exposing yourself to issues down the road because you're paying the tax in one country when it should have been the other. If you have questions, let me know. Appreciate it.